In my 10 years advising global investors and high net worth clients, I've seen people build life-changing wealth through real estate, and I've also seen people lose fortunes. The truth is, property investing can make you rich if you do it right, but it's not for everyone. When most people think of the rich and real estate, they imagine luxury homes or million-dollar developments. But here's the real story. The wealthy use property as a system, not a symbol. It's about structure, leverage, and strategy, not luck or timing. And that's exactly what we're diving into today. In this video, I'll break down how real estate actually builds wealth step by step. We'll unpack the real math behind returns, how leverage amplifies gains, and why property continues to outperform even in today's high-interest environment. I'll also share the 3 biggest mindset shifts that separate amateur investors from professionals, and end with my top 10 insider tips to avoid the most expensive beginner mistakes I see in my consulting work. Whether you're just starting out or already own a few properties, this will give you the strategic lens the wealthy actually use to turn real estate into a wealth engine, not a financial burden. Because in today's world, where interest rates are high and opportunities are fewer, understanding the strategy behind property wealth isn't optional, it's essential. So, how does real estate actually build wealth? It comes down to 3 simple, but incredibly powerful wealth drivers. Number 1, cash flow. This is the income your property generates through rent. When done right, your rental income covers the mortgage, the maintenance, the insurance, and ideally still leaves you with profit every month. That steady cash flow is what gives you financial stability while your asset quietly appreciates in the background. Number 2, leverage. This is where real estate becomes truly unique. Unlike stocks or bonds, property allows you to control a large, appreciating asset with a relatively small deposit. For example, a $50,000 down payment might control a $250,000 property, meaning your returns are amplified on borrowed capital. That's why the wealthy love real estate. It multiplies returns without multiplying effort. And number 3, appreciation. Over time, as the property value rises through market growth, development, or simple demand, your net worth grows even while you sleep. Now, when these 3 forces work together, something remarkable happens. Your rent covers the debt, your tenant effectively pays down your loan, and your property quietly appreciates in value. You're building equity without lifting a finger. That's the quiet formula behind countless ordinary investors who became wealthy not overnight, but steadily, systematically, and sustainably. Because when you understand these drivers, you stop chasing quick wins and start building compounding wealth through structure and time. Now let's get practical. Let's look at the real math behind how real estate builds wealth. Imagine you have $30,000 to invest. You could put it in an index fund, leave it sitting in a savings account, or use it as a 10% deposit for a $300,000 rental property. Here's how that plays out. You take out a mortgage for the remaining $270,000 at 4% interest over 30 years. That gives you a monthly payment of roughly $1,300. Add about $400 in property taxes and $250 for insurance, and your total monthly cost comes to around $1,950. Now, suppose your rental income is $2,000 per month. You're roughly break-even on cash flow, maybe even slightly positive depending on management costs. At this point, most new investors stop there and think, so what's the upside? But here's where the magic of leverage and time comes in. Fast forward 30 years, your tenant has effectively paid off your entire mortgage. That same property, appreciating modestly at 4% per year, is now worth roughly $970,000. You started with $30,000, and you now own an asset worth nearly $1 million. That works out to an annualized return of around 12%, and that's not counting tax benefits, rental increases, or reinvested cash flow. Why so high? Because you're earning returns on the bank's money, not just your own. That's the true power of leverage. It multiplies your equity growth. But, and this is important, as a finance consultant, I always remind my clients, leverage magnifies both gains and losses. It's not free money. When property values drop or rent stagnate, debt can turn from a tool into a burden. So the secret isn't just using leverage, it's managing it intelligently. Know your numbers, maintain cash reserves, and let data, not emotion, guide your decisions. Because when used correctly, leverage isn't risk, it's controlled acceleration on the road to long-term wealth. Let's talk about something every investor feels: inflation. Over time, inflation quietly erodes the value of cash. A dollar today buys less tomorrow. But real estate, as a tangible, finite asset, tends to move in the opposite direction. That's why it's considered one of the strongest long-term hedges against inflation. While currency loses purchasing power, property values usually rise, and more importantly, rents rise with it. Think about it this way. When inflation bites, your mortgage payment stays fixed, but your rental income tends to climb. So as costs rise in the broader economy, your property often becomes more profitable, not less. Over decades, this simple principle can be life-changing. Your debt gets cheaper in real terms, your equity grows, and your cash flow strengthens. That's why many of my high net worth clients view real estate not just as an investment, but as a long-term protection strategy for their wealth. Because in a world where money loses value every year, owning assets that rise with inflation isn't optional, it's essential. Now, one of the most common questions I get is, should I invest in property or should I just stay in the stock market? Let's look at this through the data. When we compare both asset classes, here's what the numbers tell us. Real estate typically delivers 8 to 12% annual returns, especially when you factor in leverage, meaning you're controlling a large asset with a relatively small amount of your own capital. Leverage potential? High. Volatility? Moderate. Liquidity? Low. It takes time to sell. Now stocks, particularly broad index funds, return around 7 to 10% a year. But here's the difference. There's no leverage, volatility is high, and liquidity is immediate. You can buy or sell in seconds. So, what does that really mean? The stock market compounds faster if you stay consistent, but real estate gives you control, stability, and major tax advantages. In short, stocks grow wealth passively, while real estate lets you engineer it. Let's be clear, every investment carries risk. And real estate, despite its advantages, is no exception. The most common risks I see are vacancies, months when your property sits empty, bad tenants, who damage property or delay payments, maintenance shocks, unexpected repairs that eat into cash flow, legal issues from contract disputes to compliance oversights, and of course, market downturns where values temporarily fall. Now, as a finance professional, I'll tell you, the solution isn't to avoid these risks, it's to manage them intelligently. Start by structuring properly. Hold property through the right legal entity, maintain accurate records, and separate personal from investment finances. Then, insure adequately. Landlord insurance, liability protection, and emergency reserves act as financial shock absorbers when things go wrong. And finally, screen tenants carefully. A good tenant is not just rent on time, it's asset preservation and peace of mind. Because at the end of the day, real estate isn't risky when managed professionally, it's risky when managed casually. Build systems, not stress. And let structure, discipline, and due diligence be your first line of defense. Now that you understand how real estate builds wealth, let's get practical. Here are my 10 professional tips to help you protect your investment and avoid costly mistakes. Number 1, use an LLC or company structure. Always protect your personal assets. Hold properties under a properly registered entity. It separates your liability and adds a professional layer of protection. Number 2, get landlord insurance. Standard homeowners insurance doesn't cover rental risks like tenant damage or loss of rent. This one detail has saved my clients tens of thousands in claims. Number 3, screen tenants properly. Run credit, employment, and background checks every single time. It's cheaper to spend $50 upfront than thousands on an eviction later. Number 4, act fast on missed payments. Don't let one bad tenant destroy your cash flow. Enforce lease terms early, document everything, and keep emotion out of the equation. Number 5, understand local security deposit laws. Non-compliance can cost you heavily in penalties. Know your jurisdiction and treat tenant law as part of your business compliance. Number 6, buy at the right price. You've heard it before. You make your money when you buy, not when you sell. Run the numbers before emotion and always negotiate based on data, not desire. Number 7, run numbers with conservative assumptions. Always add a 10 to 15% buffer for maintenance and vacancy. It's not pessimism, it's professional realism. Profitability is built on prudence, not optimism. Number 8, build good credit. Strong credit means lower rates, higher leverage, and better refinancing options. In real estate, your credit score is a financial asset. Treat it like one. Number 9, understand tax benefits. Real estate offers powerful tax tools, depreciation, deductible expenses, and in some countries, 1,031 exchanges or their global equivalents. Used correctly, these can add several percentage points to your annual return. And finally, number 10, think long-term. Real estate wealth compounds over decades, not months. Ignore the noise, stay disciplined, and focus on cash flow, not quick flips. Because at the end of the day, property investing isn't about chasing trends, it's about building systems that protect and multiply your wealth for years to come. If you get these 10 right, you won't just own property, you'll own a portfolio that performs like a business. Now, here's something I always tell my clients, real estate isn't for everyone. If you're not comfortable managing people, paperwork, or property, that's perfectly okay. Not everyone wants late-night maintenance calls or complex tenant issues. But that doesn't mean you can't benefit from real estate. You can still gain exposure and the same long-term wealth advantages through REITs, real estate ETFs, or private property funds. These vehicles allow you to participate in the real estate market without owning or managing physical assets. They provide diversification, liquidity, and often steady dividend income, ideal for investors who prefer a hands-off approach. Because smart investing isn't about doing what everyone else does. It's about choosing the strategy that fits your goals, your risk profile, and your lifestyle. Real estate investing isn't about getting rich overnight. It's about turning one smart, intentional decision into decades of wealth growth. If you structure your investments properly, manage them professionally, and think long-term, real estate can be the foundation of true financial independence. But if you chase trends or skip the math, it can quickly become a very expensive mistake. After advising clients across global markets for over a decade, one truth always stands out. Wealth doesn't come from timing the market, it comes from time in the market. Patience, structure, and strategy will always outperform hype. If you'd like me to create a follow-up video showing how to evaluate your first rental property using real numbers and ROI metrics, drop it in the comments below. And if you found this valuable, subscribe for more data-backed financial insights to help you build wealth the smart, sustainable way.